there's been a lot of discussion over the years, last 4 or 5 years, of, hey, when I'm looking at a bull put credit spread, what do I want? Something more conservative than what Alfonzo is looking for. My default screen, oh, this was something for a previous webinar, but my default screen, I look for these weekly bull puts. I usually open these positions on Monday. So instead of being 14 days out in time, we'd be 11 days out in time. And my criteria, as you can see, I'm looking for returns, 14, 15, 16% range, but with that 85, 86, 87% probability. Through testing, through trading, playing with different numbers, I found that this structure worked best for me with the criteria that I'm using. Looking for a probability and a credit spread of greater than 85%, limiting some of that bid-ask spread there. I'm looking for a minimum return of 9, keeping it to the 2-week out time frame. And as far as the technicals and fundamentals go, looking for stocks above the 20-day moving average, because we're looking shorter term now, but also stocks that have had a positive MACD cross over the last 3 days. And as always, for any credit or debit spread where you can lose 100% of what you invest in the position, avoiding earnings between now and expiration. And this is what has met my goals. You ask, hey, Mike, if you were trading credit spreads today, what would you open? Well, if the market sentiment is in the right mode, I'd be opening bull put credit spreads, and I'd be taking 3 or 4 of these first 5 or 6 positions that come up in the search. Yeah, I'm going to do further research and analysis. Hey, I'm going to look at the stock chart. If I don't like what First Solar is showing me, I'm just going to move on to the next one. NVIDIA. Yeah, we know what's happening on Monday with NVIDIA, that 10-to-1 split. So we're all waiting for that to see what happens. I will say that I think it was the last 3 splits that they've had, just like Amazon's last split when they, was it there's 10-to-1 too? I don't remember. But when they went down to the 120 or 118 range, I picked up 100 shares of 118. Amazon promptly dropped down to $85 over the next month, so I averaged down. Now Amazon is where it was, but yeah, I got in after the split, and it didn't work out. And NVIDIA's last 2 or 3 splits, I think the stock fell each time after the split and then took some time to recover afterwards. This doesn't appeal to Alfonso's trading technique. I understand that. This is what works for me and for my goals. That doesn't mean I'm a better trader than Alfonso. That doesn't mean I'm a better success rate than Alfonso. But in this case, you see why I'm doing this. It's because I want the better probability of these positions expiring worthless while still earning 14, 15, 16, 17% every 11 days. Because remember, I'm actually opening on Monday after my spreads clear out the following Friday for the next 2 weeks out in time. But this is protection. This is more conservative. The returns are half of what Alfonso, a third really, of what Alfonso is seeking, and that's perfectly fine. So you've got to come down to what is your risk-reward tolerance on those positions. I just wanted to show you this because this is what I look for in these strategies, and these would be this First Solar trade, selling the 242.5 put and buying the 240 put, a 2.5 spread, and getting a 40-cent net credit with a max risk of 210 or 211 is an 18.8% return with an 87% theoretical probability of First Solar now at 267.34, remaining above 242.50 in the next 11 days. And a parity trade would be the bull call debit spread. If I open the same call, sold the 242.50 call for probably $16, $17, and bought the 240 for 18 or 1760, 1770, we'd have, the 220, oh, sorry, I said that math wrong, I apologize, but we'd have on a 250 spread, we'd have probably a 210, 205 debit, so the max return would still be 40 cents, but with an 87% probability. But years ago, this idea came out about using farther out in time debit spreads. Instead of 1 week out, 2 weeks out, 1 month out, going 2 or 3 months out in time. And instead of having a risk reward, look, what was that risk reward on my bull put credit spread? I'm making 40 cents to risk 210. It's a 5-to-1 risk reward ratio. How can you make money with that? Well, I'm right 87, 88% of the time with those positions. So it works out in my favor. With management, Management is key in any spread, whether you're looking for these at or out of the money spreads, whether you're looking for lower probability and higher return, or you're looking for lower return and higher probability of success rate. Management is still key. I never let any spread that I'm in go beyond a 50% loss. Those of you who are on the presentations before for me, that's my hard stop. If I hit 50% of the maximum loss in the position, I get out because I can't afford to take 100%. We're going to watch that in just a moment. But this idea of the at or just slightly out of the money, out in time bull call debit spreads started to become very popular. So we have a sample search here, the OTM out in time bull call debit spreads. And here we're seeing Dell at 129.97. I'm sorry, I just paused for a moment. That hurts. In 2008, 2009, when we first got introduced to the radioactive trading techniques from Kurt Frankenberg, Dell was one of my first 3 trades in the married put technique, and I think it was trading at 14.97 when I bought it. So, yeah, I've traded other stocks and have had success, but years ago there was a Domino's Pizza when it came up. I traded Domino's Pizza as a married put at $18 back in 2010. And someone mentioned a webinar, I pulled it up, it was 350. And you just start to think of those little things. Why didn't I just hold 10 shares for the long term? Why didn't I hold 50 shares for the long term? Anyway, seeing Dell at 129.97 just brought that back. But here we are. We're not selling an in-the-money call, short term, for higher probability. We're looking at an October 130 call, 133 days out in time with a bid of 1560 and an ask of 5090. Very reasonable to get a midpoint of 1575. This one a little tougher, buying the October 125 call, so it's a 5-point spread, but paying 1790 to 1880. Would I get 1835, 1845? Maybe. But if I did, my net debit is only 260 on a 5-point spread, almost a 100% return. Why is this different than what Alfonzo was asking? These type of spreads that were discussed with the at or just out of the money, you're looking at a 1-to-1 risk-reward ratio. 260 net debit against a 5-point spread. 113 debit against a 2-point spread. Probabilities are all below 50. But the concept of this approach is that you're not holding it to October expiration to realize the full profit of near 100%. Oh, I'm sorry, 92.3%. My apologies. What they were looking to do is that the stock moved up 4, 5, 6% in the first 60 days or so, or half the time period of the expiration, and you could realize a 50% return. You could close out for a profit of 120 instead of the max profit of 240, 133 days away. You would take 50% of that maximum profit, but you'd also close the position if the stock fell and the liquidation value was 130 or half of the maximum potential at risk. This is sort of the at or just out of the money long-term debit spread discussion. And of course, it requires more management, meaning that you have to watch it. You have to put your alerts in your portfolio, alerts in the power options portfolio that, hey, if I get 50% of my expected return, I'm going to go ahead, move to my broker and close it out. If I hit 50% of the maximum risk, I'm going to go ahead, close out the position. But you're starting off with almost a 1-to-1 risk-reward ratio because a lot of people started to fear this idea of the higher probability out of the money credit spreads or deep in the money debit spreads where I'm looking to make 15% return, but as we saw, that might mean making 40 cents or so on a 210 risk or a 5-to-1 risk-reward ratio. Honestly, it's usually a lot more than that. A 15% return usually comes down to the fact of making, a ratio of 7-to-1 or 8-to-1 risk-reward ratio. But over here, we have a 1-to-1 risk-reward ratio. So isn't it better? Only if you're successful more than 55% of the time. That's the case. With the higher probability positions of 85% or higher, we're usually seeing a success rate of 83 to 87%. In the wheelhouse of what we want to be successful with a 7-to-1, 8-to-1 risk-reward ratio. What Alfonso is looking for is more of a 50% And we saw some examples of a good 40, 45, 50% return with a 70, 68% probability, which is pretty good. But again, you need to be in that wheelhouse and be right that often and control the risk in order to be profitable.